$10 trillion. That's not a headline number, that's a warning sign. In just days, Japan, the world's third largest economy, and cracks are now forming at the worst possible moment. Long-term bond yields are surging to levels never seen before. Panic has already reached Washington. This isn't a future problem. This is unfolding right now. Most people hear sovereign debt crisis and tune out. It sounds distant, boring, like something that only matters to economists in suits. But this one is different. Japan owns money. They travel straight into the US financial system. Before we go deeper, if you value clear, take a second to like this video and subscribe to Past and Profit. It helps the channel reach more people who want facts over noise, and it keeps you plugged into developments that directly affect your money. Japan's total government debt sits at roughly 10 trillion US dollars, more than 230% of its GDP. That's the highest debt to GDP ratio in the developed world. For decades, Japan managed this by keeping interest rates near zero. Borrow cheap, roll the debt forward. Recently, Japan's central bank raised interest rates to the highest level in more than 30 years. That sounds small on paper, but when you're carrying $10 trillion in debt, every bond that matures has to be refinanced at higher rates. Every percentage point adds massive strain to the budget. And the bond market noticed immediately. Long-dated Japanese government bonds, including 40-year bonds, saw yields spike above 4% for the first time ever. Traders described the moves as chaotic. Selling fed more selling. Liquidity dried up. And behind the scenes, phones started ringing in Washington. Why would U.S. officials care about Japanese bonds? Because Japan is the largest foreign holder of U.S. treasuries, roughly $1.2 trillion worth, more than China, more than anyone. If Japan is forced to raise cash to stabilize its own finances, those treasuries become a source of funding. And if even a fraction of that pile hits the market, U.S. bond prices fall and yields rise. When treasury yields rise, your mortgage rate doesn't stay put. Neither does your car loan. Neither does your credit card interest. This is how a crisis thousands of miles away ends up in your monthly budget. But that's only one layer of the problem. The bigger risk sits under the surface, and it's something most people have never heard of, even though it's been shaping markets for decades. The yen carry trade. For years, investors borrowed Japanese yen at near zero interest rates and invested that money into higher yielding assets around the world. U.S. stocks, U.S. bonds, real estate, corporate credit. This trade grew massive, estimated in the tens of trillions of dollars globally. It worked as long as Japan kept rates pinned to the floor and the yen stayed weak. Now that Japan is raising rates, that trade starts to break. Borrowing costs go up. The math changes. Investors unwind positions. They sell assets, convert dollars back into yen, and repay loans. That means selling pressure across global markets, not gradually, but often all at once. This is why you're seeing sudden, violent moves in bonds, stocks, and currencies. And it's why timing matters so much right now. Japan is heading into an election, and both political sides are promising more spending, not less. More stimulus, more borrowing, no clear plan to pay for it. Markets hate uncertainty, especially when debt levels are already extreme. Here's where this stops being just a Japan story. LG global bond markets are tightly connected. If U.S. yields rise because of Japanese selling, investors demand higher yields elsewhere to stay competitive. All get dragged higher. Germany, long seen as the fiscal disciplinarian of Europe, has already broken its own debt rules. Borrowing is surging. Growth is weak. Demographics are turning negative. The UK is dealing with bond yields higher than during the crisis that collapsed a government just a few years ago. These are not isolated problems. They share the same root cause: too much debt, too little growth, and rising interest costs. This creates a dangerous feedback loop. Higher yields increase government interest expenses. That widens deficits. Wider deficits mean more borrowing. More borrowing pushes yields even higher. Eventually, markets start to question sustainability, and confidence erodes fast. Now bring it back home. What does this mean for you as an American investor or saver? Start with treasuries. If Japan sells aggressively, U.S. yields could spike, hurting bond prices in the short term. But in a full-blown global panic, money could also rush into U.S. assets as a safe haven, pushing yields back down. The direction depends on which force dominates, forced selling or fear-driven buying. Mortgage rates are tied closely to the 10-year treasury yield. If that yield jumps, mortgage rates follow. If it falls, borrowing gets cheaper. Watch that one number. It tells you more about your housing costs than almost anything else. Your 401k faces mixed pressure. International stocks are vulnerable if global growth slows and currencies weaken. U.S. stocks could see volatility, but relative strength if capital flows into America. Cash becomes valuable in uncertain periods, even if yields eventually fall. The dollar usually strengthens during global stress. That makes imports cheaper, but hurts exports. Some industries feel pain, others benefit. This is why blanket predictions don't work. Context matters. What makes this moment especially fragile is timing. There's little room for error. Debt levels are high, political tolerance for austerity is low, central banks have fewer tools than they used to. That doesn't mean collapse is guaranteed. It means volatility is. The $10 trillion panic isn't about a single bond auction or a single election. It's about a system stretched thin, where small shocks can produce outsized reactions. Markets move not just on facts, but on confidence. And confidence can disappear quickly when debt math stops working. At Past and Profit, the goal isn't to scare you or tell you exactly what to buy or sell. It is to give you the framework to understand what's happening so you can make smarter decisions based on your own time horizon and risk tolerance. Panic decisions destroy wealth. Informed decisions protect it. Over the next few weeks, watch how Japan's bond market behaves. Watch U.S. Treasury yields. Watch how currencies move. These signals will tell us whether this remains a contained scare or grows into something larger. And now I want to hear from you. Do you think this $10 trillion debt situation turns into a global bond crisis? Or does the system absorb it like it has so many times before? Drop your thoughts in the comments. And if you found this breakdown useful, the more people understand what's happening beneath the headlines, the better prepared we all are.